global central banks have bought 2,000 tons of gold in just the last 2 years. This is the largest buying spree of gold by global central banks over the last 15 years. Gold is breaking out to new all-time highs from a more than decade-long basing pattern. The technical structure is incredibly strong, with all moving averages pointing upwards. The recent performance of gold is equivalent to the gains seen in the S&P 500, which has also reached record highs due to the excitement around narratives like AI. Gold, essentially a rock with no guaranteed yield for investors, has been able to match stock market returns. Several factors are fueling this surge in gold prices. High economic uncertainty in the U.S. and unprecedented demand from central banks seem to be the key driving forces behind this move. We'll look into these factors in this video and explore whether they have lasting potential. We'll also cover the key developments you should watch out for. One measure of recession risk based on yield curve inversions indicates a 70% chance that the U.S. economy will be in recession in mid-2024. This Federal Reserve Bank of New York model has had a fairly good track record of pinning down past recessions. We can see that every time these recession probabilities reach 40%, a global economic downturn typically follows in the couple of years after. The only exception to this was in 1967. A big factor driving investors towards gold is this increasing risk of a recession, leading investors to flock to gold as a defensive asset. Inflation has also been back on the rise again in 2024, and we know that gold is typically regarded as an inflation hedge. A metric called supercore inflation shows this quite well. This index focuses on prices that change slowly, otherwise known as a sticky inflation. It has remained quite elevated over the last few months relative to what we have typically witnessed over the last 20 years. Sticky inflation suggests that inflationary pressures are deeply embedded in the economy, making it difficult to stabilize prices without triggering big economic disruptions. This leads to higher economic uncertainty, driving investors towards gold, which is traditionally seen as a safe haven asset that retains its value during times of economic volatility. But the largest direct driving factor of gold over the last 20 years has been by far real yields. Until very recently, the two have traded incredibly closely to one another. Notice that the scaling of real yields is inverted. This means that most of the time, real yields and gold have a very strong inverse correlation. That's because gold is an inflation hedge. Real yields are the interest rates on investments like bonds after taking inflation into account. When real yields fall or go negative, it means the return on investments are not keeping up with inflation. More simply, the money investors earn from these investments is not enough to keep up with the rising cost of living due to inflation. Investors then turn to gold as a safe haven asset because it tends to retain its value. So falling or negative real yields drive up demand for gold, pushing its price up. As we discussed earlier, we are seeing a combination of rising recession probabilities and sticky inflation today, which is a cocktail that typically leads to lower real yields, and so an environment where gold prices can rise. But today, we are seeing a big gap between real yields and gold. It's almost as if gold is already pricing in that real yields are going to reverse and close this gap, which could push gold prices even higher. But many believe this actually poses a major risk to gold. The worry is that gold could quickly snap back to a level that aligns with real yields. A strong economy and low inflation could keep real yields high, which in turn would put downward pressure on gold prices. In fact, a few recent economic reports have shown that the U.S. job market remains resilient and that inflation is cooling down. We can see that has immediately put downwards pressure on gold prices. Traders that are bearish on gold want to be watching this big long-term breakout. If gold were to fail to hold it, it could suggest that gold is ready to snap back to what real yields are saying. However, there are reasons that explain why this gap actually exists. One of those reasons is the massive gold purchases by central banks, particularly the Chinese central bank, which has increased its gold reserves by around 20% over the last year. But it's not just the Chinese central bank. Chinese investors are also buying gold. The number of shares outstanding in Chinese gold ETFs has skyrocketed over the last year. This shows that more Chinese investors are buying these ETFs. Why? China is in the midst of a profound economic crisis, particularly affecting the real estate sector, with the value of Chinese properties declining for the first time in over a decade. Chinese investors are notorious for investing heavily in their real estate market. But if their confidence in Chinese real estate is plummeting, it could mean that Chinese investors are redirecting capital away from their real estate market and into alternative assets to park their money, such as gold. If the economic crisis in China worsens, it would likely continue to drive gold prices up as investors flock to this safe haven asset. Now, in the short term, if gold pulls back, where could it find support? Historically, the 150-day moving average on gold is key. It acted as an important level of support between 2018 and 2020. Today, gold is still around 6% higher than its 150-day moving average after its rapid breakout earlier this year. Of course, There's no guarantee that it will hold this moving average. You can also see multiple instances where it has broken below it. But gold also bounced off its 150-day moving average several times during the global financial crisis in 2009 and the European debt crisis in 2011. This makes it a very important level to watch for anybody looking at gold today. If you're looking to trade gold or other commodities like silver, look no further than Capital.com.